Welcome to the Springfield Properties PLC half-year results to 30th November 23. My name is Iain Smith. I'm Chief Executive Officer of Springfield. I've been with the business for almost 20 years and we've been on the stock market since 2017. To my left is Martin Egan. Martin joined us when we acquired Dawn as Managing Director and is now Chief Operating Officer. QS trade is all his qualification can be seen at the bottom there. To my right is Iain Logan, who is Chief Financial Officer, appointed in July 2023, but been with Springfield 4 or 5 years with over 20 years of experience as a chartered accountant. Okay, so good to see some of you again, although I can't see you. It's good to speak to you again. For those that I haven't met before, nice to meet you. This is an update from September, and the main points that we're making today is that we're on track to hit our year-end figures. We have taken a number of significant actions this year which have been successful, and that gives us some substance behind our confidence in hitting the year-end projections. As we will show throughout the presentation, we will talk about the private housing market and how we believe it is picking up, and we've got some evidence of that. We have managed to sign affordable contracts since we last spoke to people in September. Some 40 million of contracts have been achieved, with more to come. We have land sales which have been secured, some 18 million, with again more to come in the future, and we've managed cost savings of some 4 million a year annualized. Going forward, decisive action to reduce debt. We recognised that debt was too high at the end of last year and when we came down in September, and we really focused on the target, and that target is to get debt down to 55 million pounds. We have an asset base of some 277 million, so we believe that's a good place to get to as a first step. And once we get there, we'll have the opportunity to work in our land bank, which is some 6,500 plots, 90% of which have planning. What have we done? We've carefully managed our working capital. Speculative private house building was paused. We had soft launches at new development. That basically means before we start a new site, we make sure we've got sales and we've got interest. We've signed some 40 million of affordable contracts, which are positive working capital, as I will explain as we go through. We've had a focus on cost control, generating annualised savings of some 4 million pounds, which has basically been a consolidation of businesses, and it has not impacted our performance. Actively pursuing land sales, we agreed 18 million. We had said we would target over the next 2 years between 24 and 25 of 50 million, and we're making great headway in that with more sales to come. We've significantly reduced our land buying activity. Obviously, we have a large bank. We've really built our land bank up over the last 5 years through acquisitions. And with all of the difficulties that we're aware of with planning, we think that is a very valuable asset. We have paused dividends up until bank debt is materially reduced. And you'll see from the projections that are out in the market and on our website that they are returning in 25 if we continue along the track that we are going. So, over to you, Iain.
Thanks, Iain. Afternoon, everyone. The key positive from a financial perspective is that we're on track to hit our May 24 numbers, which is a profit before tax and exceptional items of 10 million pounds, and as Iain said, reducing the bank debt to 55 million. If we look at the revenue for the 6 months to November 23 versus the revenue for the 6 months to November 22, it's 120 million versus 160 million. The main movement is in private housing, which is in line with what other house builders are reporting. Our gross margin has improved from 14% to 14.7%. This is a result of an improvement in the affordable margin, which we'll talk about in the next slide. Another positive for us is admin expenses. Iain mentioned the fact that we've achieved annualised cost savings of 4 million. And that's starting to feed through in these numbers where we've reduced from 14.7 to 12.6 million in this period. Our profit before tax in the period is 2 million versus 6.6 million. Aside from the revenue and the profit coming down, we've also paid 3.6 million of bank interest in this period versus 1.6 million previously. That's a function of higher interest costs and interest rates and higher bank debt, which is obviously something we're looking to bring down. Next slide, please. Private housing completions are down again in line with wider market trends. Our average selling price though in the period has increased from 277,000 to 314,000 per home. That's a function of higher prices across all of our brands, higher selling prices, and the mix of the homes we're selling. Going on to affordable housing, again, our revenues are down. That's in line with the strategy whereby we stopped signing affordable contracts for a period. But again, as Innes has mentioned, that's a landscape that's come back and is attractive for us. So we're currently signing new contracts, and those revenues will increase as we move forward. On contract housing, the revenue has gone from 10 million to 2 million. This was a result of a planned pause in our private phase at Bertha Park, whereby we completed the current phase in August and September, and we wanted to wait till we saw better market conditions, which we're now seeing. So we're having a soft launch in the coming weeks, which will see those revenues rise again. We've also signed a new affordable contract at Bertha Park, which again will help with the revenues. In the previous period, there was PRS revenues at Bertha Park as well, which we haven't seen in the current period. Next slide, please. If we look at the balance sheet, our total assets have reduced by £20 million to 327 million. This is as we would expect with lower work in progress due to the lower volumes. And we've also got lower accounts receivables from affordable contracts as the existing contracts tend to come to an end. Other liabilities have reduced significantly to 83 million, a 55 million reduction. A big part of that is deferred consideration payments. We've made £17 million worth of payments in the period. 13 million relates to the Tulloch acquisition, with those deferred payments completed and nothing further to pay. And we've made the first payment in relation to the McTaggart and Nickel acquisition. Bank debt has increased from 67 to 93 million. Again, the main part of that is the deferred consideration payments and some land purchases. What's important when looking at the bank debt figure of 93 million is that of the 18 million of land sales that we've secured in the first half, 15 million of that cash is set to come through in the second period, which will automatically come off the 93 million. We go on to the next slide, please. So this slide shows the bridge from net debt of 67 million in November 22 to 93 million in November 23. Working capital and land payments account for 17 million, interest and tax 8 million, 17 million of the deferred consideration payments on the acquisitions that we've talked about, and offsetting that's our operating profit of 18 million in the period. The most important thing on this slide for me is how we go from the 93 million in November to the 55 million at May. We always have a working capital swing in the second half, whereby we hand over more private homes. So typically, we're building up our cost and our work in progress in the first half of the year with a weighted handover of private homes in the second half. So there's always a natural working capital inflow in the second half. We've got some more affordable contracts that we're working on, which will have a positive cash contribution in the second half. And as we said, 15 million of land sales to date, which will bring that debt figure down.
Okay, this schedule here basically shows the land holdings, and I'll just try and take you through this. The dark green there, you can see our total inventories, which is 277 million, represented by 103 being land and 174 being work in progress, which is infrastructure, houses, sewers, roads, etc. That's represented by 6,500 plots that we fully own, and 86% or 90%, if you want to round it up, with planning. That is a particularly high number, and this is what we keep trying to emphasize, that the asset we have built up over the last 5 years, there are huge problems with planning. I think we're all aware of those. However, 90% of our balance sheet land has planning on it. Land has been secured off market, resulting in an attractive cost price of some £16,000 per plot. That is 103 million divided by 6,500. To the right there, you can see the strategic land. Now, the strategic land are options that we have over future land, and none of that is represented on our balance sheet. Now, that is options over some 3,200 acres, which if you take 10 plots per acre, equates to 32,000 plots. Now, clearly, some of that will be speculative, some of it will be with planning, some of it will be zoned, some of it will be agricultural land. But the important number that we have there is 14% of that does have planning. So that's equivalent to another 5,000 plots. And that's 2,000 plots in Stirling, about 2,000 plots in Elgin, and there are various other ones in there. Clearly, some of the other stuff will come through, so that gives us a really good pipeline going forward. As you can see there, we have sold 3 pieces of land in the period. Those land sales were for, well, over the period and to this date, some £18 million. We've announced each of these to the market when they've happened. We have sold those in open market, and we've had closing dates on them, and we've sold to private equity-backed house builders. We've had interest from national house builders and from private house builders. They have sold on average at around about £50,000 per plot. All of those sales of land were on larger sites, maybe up to 400 houses for 2 of them, and they were not in our sales plan for 3 years. So they were acquired in the last 3 years through our other acquisitions, and all were done profitably. One of the other sites, which is not a 400 site, but it was a site that was part of the Walker acquisition, had £8 million worth of infrastructure that was required. So we did not think that was good use of capital just now, and sold that and made a small profit. As you can see at the bottom, we have an extremely large land bank, and to the right, you can see we cover most of Scotland, probably with the exception of Aberdeen. Next slide.
Thank you, Innes. Afternoon, everyone. With regard to private housing, demand has been impacted by the reduction in affordability, and this resulted in the active measures that we took in September of last year to reduce our work in progress spend. And we introduced strict build hold stages throughout the group, and that has allowed us to more closely monitor cash outflow. Although the market has remained subdued over the period, the past 5 weeks have seen sales average throughout the group at 15 per week, and private sales now represent 90% of our target for the year. Sales prices remain resilient across the group, and we are experiencing marginal price increases. The outlook on sales volume over the coming 12 months has turned increasingly positive, supported by the expectation that interest rates will ease as the year progresses. The forecast in particular for the Scottish housing market, based upon the latest RICS survey information, shows a positive uptick in the key 5 housing metrics for housing. We continue to offer a high level of specification of standard in comparison to our peers, and have implemented new operating procedures within the period in accordance with the new Homes Quality Board, with all homes now being completed 2 weeks prior to client handover. This significantly reduces snagging items and ultimately improves quality for our clients. Next slide, please. With regard to affordable housing, after the pause being taken on entering fixed price affordable contracts owing to build cost inflation, we have recommenced engaging with affordable housing providers, with forecast inflation for the upcoming 12 months to be circa 2.5%. Tender costs, we believe, are now more stable, and this, coupled with the Scottish Government increasing affordable housing benchmarks, makes previously unviable projects far more attractive again. We are receiving strong demand for our affordable housing offering, and since May 23, we have signed £40 million worth of contracts across multiple locations in Scotland. The market fundamentals of affordable housing remain strong, and we are actively growing this part of the business once more. Next slide, please. With regard to build quality and product, etc., significant work has been undertaken to rationalise and improve the portfolio of our house types across the group. In doing so, we have consulted with all the departments and focused on saleability, plotting efficiency, commerciality, buildability, improving build quality, and minimising defects from the build processes. We have went through a robust selection of process and ensured that we have a range of house types with adequate floor space gapping from 700 square foot through to 2,500 square foot, which largely covers 2-bed mid-terrace properties through to large 5-bed detached properties. We've also taken the opportunity to simplify our construction detailing across the range. The net effect of this rationalisation and selection process showed that we only actually required 2 new house types out of the 40 that were already within the group. A significant benefit of this review has been the positive impact on our plotting efficiency, with more sellable square footage to the acre of land being achieved, and this will impact future planning applications with increased density of square footage. The increase of this additional sellable square foot area will mitigate the impact of upcoming cost increases associated with environmental and building standard changes in Scotland. In undertaking the process, we have focused on enhancing the quality, space and character of our house type design, whilst further embracing modern methods of construction by utilising crane erect on all of our product, incorporating just-in-time delivery methods, minimising build durations, whilst decreasing health and safety risks. By increasing the quality from these consistent build approaches, we will undoubtedly improve already high standards of build quality, whilst further minimising our defects. Next slide, please.
Okay, housing market. So I'm just going to go off-piste here from the presentation, just to kind of give those that are new to the story as to why we're in the position we're in just now, and the focus is very clearly on debt. Just bringing back to 2020, in March 2020, as COVID was coming, we signed two very large contracts worth about 40 million for affordable housing, and it was 6-storey blocks of flats, one in Glasgow, one in Edinburgh. At the time, it seemed like absolutely the sensible thing to do because it guaranteed revenue streams while there was a lot of uncertainty with COVID coming, and it guaranteed revenue and profits going forward, we thought. What actually happened was that after COVID, there was a huge boom in the market. Cost price inflation went up to 20%. Labour became very scarce. Suppliers became very scarce. The subcontract chain all became very weak. And we ended up with those contracts where we had a fixed sales price based on March 20 and with cost price inflation of 20%, and even had subcontractors going bust, that we struggled significantly and ended up making losses on those contracts. Now, at the same time, we decided to withdraw from affordable, and because affordable was very cash flow positive, that had the opposite effect when we withdrew from it. That position has changed since now, and we have seen an increase in the benchmark for affordable housing of 16%, and that is why we are willing to sign contracts at 40%. The other thing that has changed is that cost price inflation is around about 2.5% now, and that is manageable with shorter term contracts. Some 12 months is kind of the longest we're really signing now with affordable housing. We are also sticking to doing housing. We will not do but the one lesson we have learned from doing 6-storey blocks of flats and doing 130 times, we learned lots of lessons, but the main lesson we've learned is that's not what we do, and we are not going to do that going forward. We'll focus on what we understand, and that is building houses and doing affordable for local housing associations. So that's a bit of a background of what happened with affordable and why the margins have been suppressed in the last 2 years, which may give an indication that our return on capital is less than we would like. We obviously have a very large land base as well, which also reduces the working capital, but we see that land asset as a very valuable asset and something that we've worked very hard to get to. The second thing that happened for us was we had got firmly behind the PRS market. We have a number of large land holdings at villages. So at Bertha Park, we have 3,000 house, Jury's Hills, we have 3,000 houses, at Elgin South, 2.5, Lingerwood, 800. So we have these village sites, and they actually are really, there's a private revenue stream, there's an affordable revenue stream, and we were also exploring the PRS revenue stream. We had done a deal with Sigma where we had done 70 houses at Bertha Park, and that was going well. And we had an intention, I think in September 2022, we had a contract in place for just about to get signed for 300 houses and 100 million for PRS. And at that point, the Scottish Government introduced a rent cap. In fact, it was a rent freeze first. That killed the PRS market in Scotland. It killed that revenue stream, and it killed the land sales that we thought we were going to have. And that rent cap was put in place to March 24, where it will end. And I can speak about that at the ending and why we think that's going to come back. What then happened was that we looked at that land and we thought, well, we'll go to the private market and we will sell in the private market instead, those 5 sites. And we went to the private market and we lined up some potential purchasers, and then Liz trusted the mini budget. This is all going back to September. Obviously, the mini budget came and people stopped buying land. So we had seen our revenue streams and our 3 different diversified areas of affordable housing was suffering with the cost price inflation of 20%. We had the private housing market disappeared. and we had the PRS had gone completely. So from that point forward, we've really been making sure that we can shore up the balance sheet and get the debt down. Now, why have things changed? Why am I more optimistic now? Clearly, we've done the 40 million of signing of affordable contracts. Clearly, we've sold 18 million of land, and we have seen a pickup in the house prices and in the housing market. Why are we seeing a pickup in the housing market? Well, I think we can all see that interest rates have stabilised. I think when interest rates are going up, the psychology is, well, house prices will come down, so people stop buying. The opposite is true, that when they think interest rates are going to come down, people think, well, house prices will go up, so they start buying. If we look on the right there, the story, we hear about UK inflation figures and house prices have dropped. But if you look at the green, Scotland has actually had a 2% increase year on year in house prices. And it's really just to amplify that point here. Now, the housing market, we are obviously, it's not just our experience where Martin said we have seen sales pick up to 15 a week. Our target is 10 a week. But we are seeing from Zoopla, we are seeing from Rightmove, we are hearing from other house builders, we are hearing from Ricks. You know, it's a lot of evidence that things are happening. And clearly, you see deals like the Redrow Barrett deal go through, and there is some interest in there is obviously some positive thoughts within the industry. Scotland is the most affordable part of the UK based on house price to earnings. You see that in the chart on the right. The bottom yellow one, it may not be that easy to see in the screen, is Scotland, which is around about 3 to 4 times salary to mortgage. And the one at the top there at 14, whatever crazy number that is London prices, obviously. The undersupply of homes in Scotland is the same as in England. Planning is hard to come by. That's why our 90% planning on our land bank of 6,500 is so valuable. We've had housing emergencies declared by Edinburgh, Glasgow, and Dumfries and Galloway councils. They don't seem to understand that it's them that give permission for housing. So possibly the solution is build more houses. Homes for Scotland find a quarter of households have a housing need. I'm sure it's the same in England. You know, houses aren't big enough. There's split families. There's energy deficient needs, many different things. Scottish Government is still targeting delivery of affordable houses, and we're well placed now to take advantage of that. Significantly more mortgage variety and more mortgage availability since the dark days of September 2002. And obviously, mortgage lenders need to lend mortgages in order to make their business. And we are seeing more of those, and even up to 40 years, I think, are now available. There is a really strong need for PRS housing in Scotland. The end of the rent cap on 31st of March, it seems to me, will create an opportunity to increase the supply of PRS. It's zero at the moment. What's happened in the 2 years is not only have no new PRS been built, but also people have exited because they couldn't increase their rent, and you'll see mortgages rising or loans rising. So there is a really pent-up demand, and Scotland, unsurprisingly, has the highest increase of rents across the whole of the UK. What we see is a large pent-up demand there, and we would hope to see PRS come back. And we are well placed with 5 sites that we could do deals on pretty quickly and sell land next year, get house building going on that side. We believe that the new cap coming in, which is set at 6% per year, is allowed. If the tenant disagrees with that, they can go to a tribunal, is a reasonable amount, and should, starting from a good yield point, should give the PRS people encouragement. The other thing we just mentioned there is the Inverness and Cromarty Green Freeport. That is basically in the north of Scotland. There are 4 ports: Cromarty, Nigg, Ardsea, and Inverness. They've been granted Green Freeport, which basically means there are rates exemptions, there are customs exemptions, and lots of benefits for businesses growing there. It is expected to generate some 10,000 jobs over the next 6 years, just directly in the renewable industries and at these ports. Juventus have announced that they are investing 300 million at Ardsea, and in the global yard, there is a 500,000 square foot factory that just got planning permission last month for doing the electric cables for connecting up the offshore and wind turbines to the grid. We believe those jobs will come, and we have a very good, healthy land holding from our acquisition of Tulloch and from Springfield in the north. And we are not selling any land in that area for that reason, because we do see a good boost coming to that economy. And we just need to make sure that we can provide the housing needed for the labour that's coming in a timely fashion. Moving on. ESG, environment and people. It's what we have done. it's what we are doing and what we will continue to do. We have always looked after employees, we have always trained our staff, we've always worked well with our communities, and we've always tried to provide energy efficient, environmentally friendly houses. We think an energy efficient house leads to savings to the customer, and it's what customers want, and we see it as a good selling tool. Just on the right, you can see some of the pictures there. So, in conclusion, the actions that we have taken have strengthened Springfield's position from where we were. We've put some substance behind our plan. We've reduced the overheads. We have sold land. We have stopped spec build. We have signed affordable contracts. And all of this is resulting in us getting our debt down to 55 million, which against 277 assets gets us to a decent position. We do want to continue doing that. We've been very single-minded in our focus to get the debt down. We are almost running the business like a private business. That is our target. Let's get the debt down to 55. And if that's good for some investors, great. And if that doesn't suit other ones, fine. But we are focusing on getting to the 55. We're encouraged by the signs of recovery in private housing, with increasing recent reservation rates. We have a high demand in affordable housing. There is still a huge need. Strong interest in our land bank, with more profitable sales expected in the near term. An opportunity for return in PRS, and we still believe the Scottish housing market's fundamentals are paying supportive, and we should be able to take advantage of our 6,500 plots in the balance sheet with 90% planning. So I'd like to thank you for your support, for your interest, and I'd now like to open it up for questions.
Can you give a bit more colour on the direction of travel in private home sales and what you're seeing at the moment?
We are seeing interest rates flattening out. We are seeing mortgage rates getting more stable, getting below the 5%. There are more variety in mortgages that are being offered. The reduction in supply, which all of these planning regulations, and I know there's one thing in England, we have NPF4 in Scotland. That just means that the land bank we have with planning is even more valuable, and the demand for housing is going up. It is very much down to sentiment and seeing stable interest rates, seeing inflation coming down 4% and projected to go down to 2%, seeing energy costs going down, see the cost of living crisis coming down, all puts to a housing need that is there, and we have the houses to supply it. We are seeing, as we said, over the last 5 weeks, we've seen an increase to 15 houses a week. Our plan for 24-25 is 10 houses a week. So obviously that is a good rate. We did decide to pause. I think we've got 8 new sites that we decided to pause because we didn't want to put money in the ground speculatively while the market was in the position it is. We will be able to start those 8 sites. That will add to the sales rates that we have, and we will check the pent up demand and the waiting lists on those, and hopefully we'll be, looking at 10 sales a week. We should be looking at beating that over the period.
Leading on from those, got another question. Other house builders are offering incentives to buyers. Are Springfield doing this?
We have not needed to. We have house price inflation in Scotland. Martin, with 1%, is it we're offering? 1%.
We're finding peers are offering something up to 5% in discounts on stock properties. Fortunately, we have a strong product offering, and we are finding that it's only in select properties we're looking at 1% discounts. But on the whole, we're managing to maintain margin within our forecasts.
Yeah, and I think it's important that we, for those that are new, we offer quite a high spec house with, you choose your paint colours, you choose your kitchens, full length bathroom mirrors and various turf in the gardens. All of these things we see as should come with a house for Springfield. So where others are maybe offering those things as free, we've been offering that as part of our package. And we find when the market gets hard and the market gets tough, the houses we offer, which are more spacious, we've got more square foot per house per bedroom than other competitors or the national side. The people in harder times and the people with money that are buying houses want more for the money, not less. So, our reduction in sales, I think Iain mentioned, in line with peers, I think we're at 26%, but we're seeing our competitors saying 30%, en masse. The market, there has been a big reduction, but I think we do see in housing that we saw the cost price inflation coming before it hit the high streets. We saw the house price inflation coming we saw the slowdown in houses and the slowdown in the market happening before it got the front pages as well. And I think we'll see the pickup as well. It tends to be the case with house building that we see things early in the economy. And I do hope we're seeing a pickup from this point forward.
What might the ASP be at the year end? Several £500,000 homes for sale in Inverness.
Well, hopefully they're sold in that figure. Iain, what's the projections?
It'll be round about what it is at the half year, Rachel.
Another question. You have made various acquisitions over the last few years. Do you see the various brands operating independently and regionally, or do you plan to use them more strategically or even integrate under the Springfield brand?
I think Martin obviously covered the narrowing of the house types from 200, which is 5 brands times 40, to 40. And that gives us one common product across Scotland, that has been chosen. 38 of those are out of our current portfolio. So these will be energy efficient houses, all air source, all complying with latest regulations. The branding itself, what we've typically done is we've acquired a company and a business, and the brand has been very important for the region that they're working in. I think in time there is more pride over Springfield Group, and the brands will become a less important part of our business. If we think it's important locally, then we'll keep it. If we don't think it's important locally, then we won't. The important thing is the Springfield Group and the quality of houses, and we build that reputation there. The fact it's got a Dawn or a Tulloch or a Walker brand on it, I think is less important going forward. Because we've regionalised a lot of the businesses, then we are kind of running as one business now anyway. So I think less important going forward.
Moving on to maybe a few financial questions. First of all, how much land are you planning on selling, and when will you stop?
We have in our plan to 25 some 50 million of land sales. We've made a big bite into that just now. In the second half, I would really like to see those land sales attached to affordable deals or attached to PRS deals. There is a point where having debt when the market is bad is not a good thing. Having debt while the market is good and funding growth is a different thing. We are an entrepreneurial company. We will react to what the market is telling us, and our focus is very much get the debt to 55. Be silly to think that we're going to stick to an exact plan to the end of 25. The market is changing. The affordable market could pick up, the PRS market could pick up, and we will adjust accordingly depending what that is. Back of my head, I'd like to see debt down at 30 million, which puts us in a very strong position. And then maybe once we've got the confidence back of the market, which is reflected in our price to book that we see just now. But once we get the confidence back, then we can look at, do we need to expand again and use debt to fund that? So I think we're very much focused on getting to 55, and we do not want to sell all the family jewels. All of the land we have sold has been land that we'd kind of acquired in excess and wasn't part of our 3-year sales plan, and we don't want to be eating into that. So yeah, the question is very much, as per the projections out there, that is what we're doing just now. But as things pick up, we will react accordingly.
Just following on from that, if debt reduces to 55 million by the end of the financial year, net assets should increase to 190 million. Is that correct? And the current market cap is 100 million. What can be done to close the gap between net assets and market cap?
And that's where you come in, Rachel.
I knew that was going to be the answer.
That's the first point, Rachel.
Yeah.
Our net assets wouldn't. Market cap. Okay, you're talking about market cap rather than net asset position.
Yeah, it was just more about closing the gap, wasn't it?
Yeah, we're talking about price to book, closing that gap.
And that probably leads quite nicely on to the next question.
And it is actually, Rachel, the question we get it from the institutional investors is, that return on capital employed almost kind of says that you're better not having a land bank with planning. Reduce that to as small as possible, and that's kind of counterintuitive. Our history is Sandy Adam was a farmer, and farmers want more land and holding more land, because you don't get more land as time goes on, it's only less land. And we think we've built up a really good land bank, a quality land bank, 90%. Some of our competitors are down at 50% with planning. We have a really strong thing. We really want to highlight this to people, and this is what today's good for, is really focusing on, yes, we're going through two difficult years just now, where we are remaining profitable and, you know, we're meeting all of our obligations and everything. But once that 2-year period is off, we've got a great land bank to take advantage of, and that is only going to be worth more with all of the political meddling that we have.
I think that leads quite nicely on to the next question, which is, you know, what is your view on the Redrow Barrett deal? And I suspect I know the answer to this one, but
To me, it's a land deal, and the land deal is, you know, it's going to cut 90 million of overheads from what I read, pre-tax or post-tax, I can't remember, but it gets Barrett's numbers up to where they wanted to be 2-3 years ago. And it's Redrow have land with planning on it, so that's combining both of those together. The interesting thing on that is that Redrow were, prior to the deal, were, you know, on the market, you know, price to book probably 1-to-1, and this deal's been done at 1.2, and we're sitting at 0.6. So I think most of us, when we woke up in the morning and were taken by surprise by this, I know I got a text from Sandy Adam at 7 o'clock in the morning, and we were expecting to see, well, okay, speculation in housing, that's going to push our share price up, and well, nothing really happened. But what do we know?
there's been a suggestion that maybe highlighting your confidence in the plan could be illustrated by management buying some shares. Any view on that?
So two answers there are, because I'm part of a concert party and we're just at 30%. If I go and buy one share, I've got to buy every share, because we have to go. Whenever I buy, and you'll see this, whenever I go, and when it comes to April and I buy some shares for my children for the ice, I have to get permission from the takeover panel. So yeah, it's not easy for us to do with the shareholding we've got. But I think they're good value.
Okay.
Well, no, I don't actually, from where they are. They're good value for someone buying. They're not good value for me.
Moving on to PRS. Obviously in the presentation you sound quite confident about the prospects for PRS with the benchmarks. If that does come back, do you have the capacity to build at scale?
Yeah, so we have a site in Inverness, in Elgin, in Perth, in Dundee, in Stirling, and Lingerwood, that we could with planning permission, we could quite quickly do deals for 60-70 houses. The interesting thing with PRS is there is a mindset out there. It's at zero just now, so it has to get better than zero. So starting from a base point of zero, clearly it can't get worse from there. So we have done PRS with Sigma. We did 70 houses and it was very successful. And obviously they got spooked by the interventions of the Scottish government, which with hindsight, I mean, it was done with best intentions to protect people from rent increases, but it's just led to an undersupply of rental houses, as everyone predicted, and an increase. But what we're seeing is, what we haven't benefited from in Scotland is, I think if you look at Barrett's, maybe 10% of their sales rate was on PRS. That we haven't been able to do that. Now, the question as to whether PRS will come back is, you know, how long will PRS be able to do those deals with the big house builders? Because I'm pretty certain as soon as the private market returns, the big house builders won't necessarily be selling to PRS again. So we think, you know, from a good start point, for if yields are up at, you know, 4 to 7%, and then you've got a guaranteed 6% increase per year after, we think that's a decent proposition. We have heard people who say yes, but now there's been government, you know, there's no trust in government, you know, will people invest? Well, you know, government's done Brexit and lots of things over the last while, and it doesn't seem to affect investment there. So, you know, let's just let's see. I can only see it getting better. There's a huge need for rented properties, and you know, the other thing, by pushing up the rental prices, it means that obviously buying a house is more attractive because it's cheaper than renting.
Thank you. And final question, and it's quite a wide one. Any concerns about a potential change in government?
Concerns about potential change in government, bring it on. Yeah, and that's that. And not just governments. Can we put an S on that?
Yeah.
We've had two parties that have been in for a long time, and I think we need change. I'm optimistic, and I'm not seeing the normal thing with the general election where there's uncertainty and people are concerned. I think people can see, certainly Labour are shouting a lot about housing. The NIMBYism that we've had over the last 5 to 10 years in Scotland and in England, it gains votes in the short term for people trying to get it. But once you've got a sustained period of not building enough houses, it starts to become a genuine crisis and a genuine problem. And I think we're seeing that in society now, that governments and incoming governments are recognising we don't have enough housing. And new housing is energy efficient. I mean, if you want to hit green targets, build a new house instead of living in a 200-year-old tenement flat. You know, there's so much positive for building new houses. Each house generates something like £70,000 tax. You know, it pays for roads, it pays for infrastructure. You can't pay for infrastructure without getting money in. So, yes, I'm quite passionate about this, and yeah, I'm not political. I'm suspicious of a lot of them, but I think, yeah, time for a change. That's fine.
Well, thank you.
And I'm not speaking for this two here.
I'm sure you only ever speak for yourself, Innes. That was a great run through, guys. Thank you very much. Thanks for all the people that have dialed in. Just as a reminder, we will be sending out an email after this asking for feedback, so I'd appreciate it if you could complete those for us. And that's all. And we will hopefully see you all again in September for the final results.
Thanks everyone from the time. If anyone ever wants to come and see Springfield or see a site, please, I would encourage you to do it and see what we're actually doing. See the house, feel it, touch it. You will get more confidence from seeing what we actually do. So please contact Rachel or Hannah if that's what you want to do.